In today's video, I want to take a look at where I think we're at in the bubble phase of this bull market, and then maybe discuss a little bit about trading strategies towards the end here. So I've got the NASDAQ on the screen here, and I think this is where the bubble will manifest most powerfully. It's leading the stock market again. I've circled here. This was the 4-year cycle low in '98, the 7-year cycle low here in 2016 when QE started and ultra low interest rates. The 4-year cycle evolved into a 7-year cycle. This dip down to retest the long-term moving average, in this case the 200-week moving average, is necessary in order to set the stage for the bubble phase to begin. We had a very, very long multi-year bull market. Same thing here, especially after 2012 and in 2013 and 14, the market just went up and up and up. You have to cleanse that sentiment in order first before the bubble phase can start. You've got to get everybody on the wrong side of the market. Everybody has to believe that a new bear market has begun, and then that creates the fuel for the next phase of the bull market, the euphoria phase. You can see in '98, this 4-year cycle low, that was a very sharp pullback, about 20%. That made everybody think that a bear market is starting. That generated the fuel for the bubble phase to come. Same thing here. Everybody remembers a year or two ago when we went down into this 7-year cycle low, the Fed was starting to raise rates. The memory of this bear market was fresh, so everybody was looking for a repeat of this, and that's what generates the fuel for the euphoria phase. And so you can see here, once we broke out to new highs, the market accelerated pretty rapidly. Same thing here. Once we broke out to new highs, price accelerates very aggressively. And this was even an even bigger breakout because it was a breakout above the 2000 high as well. So I don't think we're ready to start this final 6 to 8 months yet, where price just goes vertical and the public piles into the market. I think we need between now and, let's say, the German elections in August, the Fed's going to probably raise rates again. Price is starting to get stretched quite far above the 200-day moving average. So I'm going to say we're probably in a period similar to this right here. And between now and August, one of two things is going to happen. We're either going to get in a very volatile, choppy market that just goes back and forth, similar to what happened here in '99, or we could get a correction after we get the results of the French election tomorrow. In one way or another, I think we are going to get some kind of correction. Even if we get a relief rally early in the week, I think we're going to get some kind of correction. What I would like to see would be maybe a sharp sell-off like the Brexit, a 5 to 7 day big move down very quickly that closes some of the gap between price and the 200-day moving average. That would be a better scenario for traders, in that it could then generate another strong trending move higher. If we don't see that, then I think we would be entering more of a choppy, kind of more of a sideways type market between now and August. That would allow the 200-week moving average here to catch up somewhat to price. But I would prefer that we get a corrective move after the French elections between now and the June FOMC meeting, where they're going to raise rates again. So a big correction would set up a perfect entry into a trade, as the Fed will push the market back up to those old highs in time for the June rate hike. But one or the other is going to happen. We're either going to chop sideways for a while, or we're going to get a correction and then a rally. But I don't think if the market were to rally Monday on the French election results, I don't think it's going to trigger another strong trending move up. I just don't think we're ready for this final 6 to 8 months where the public piles into the market. I don't think we're ready for that yet. So I would not be getting positioned heavily long in anticipation of another big move just yet. I think it's going to be 2018 before we can see something like this, where the public piles in and we just go straight up. And then to end this video, I want to discuss trading strategies. There are literally thousands of ways to make money in the market. But what I see happening to most people, retail traders anyway, is they jump from one strategy to another as soon as the current strategy they're using produces a losing trade. Then they automatically assume that the strategy doesn't work, and then they look for whatever's working at the moment under the assumption that that trading strategy is what they need to use to make money. And there's no better way to lose money than to just jump from one strategy to another, because all you're doing basically is chasing momentum. And then when the momentum runs out and the strategy has a losing trade, then you end up with a loss. So it's basically the same thing as buying high and selling low. What works is to find a strategy that you are comfortable with and then stick to it. Understand that it's every strategy. There's never been a strategy developed yet in the history of the world that only produces winning trades. Every strategy breaks down eventually. Every strategy is going to have a losing trade. That doesn't mean that the strategy is broken. It just means that it had a losing trade. So for me, over the last 20 years, what I have found that works best for me is a combination of cycles, monitoring sentiment, and then using some degree of technicals to try and time an entry, mostly into long trades. I rarely take short trades. Every once in a while a setup will come along, but for the most part I tend to trade mostly from the long side of the market. And over the years I've found that this particular combination works pretty good for making consistent gains in the stock market, in the metals market, and usually in the energy market, although we have not had any love in the energy market here for the last couple of years. But that doesn't mean that the strategy is broken. It just means that we're having a losing streak, and eventually we'll get back on track, and the energy portfolios will start making money again. But like I said, that doesn't mean it's the perfect strategy for everyone. Some people like pure charting. For myself personally, over the years, I've just never found a pure charting strategy to be consistent enough to where I could consistently grind a portfolio higher and higher. It seemed like a pure charting strategy would make money, and then I would lose it all, and then I would make some money, and then I would lose it all. So I searched around and found something that's, at least for me anyway, seems to work better. So as I said, here's what happens. So I'll use a classic example. We got caught trying to catch a short-term trade out of this daily cycle low. The daily cycle topped unexpectedly on day 3, and then our stops were run on this Monday, And so we took a big drawdown in the metal portfolio, and then we got out when that 1275 zone was broken. Luckily managed to avoid this here, and then got back in at the bottom. Well, classic example. A lot of traders abandon the strategy when when this started to move down here, or when we got the stops run here, assuming that the strategy just doesn't work. And unfortunately, they missed this rally, and where we made back all of those losses, the losses that we had from here, we made it all back, and now we're considerably higher at this point here than we were at the summer top, even though gold is quite a bit lower than it was back in August of last year, and the miners are a lot lower than they were back here in August. But I trust the strategy to it doesn't work 100% of the time, but over time it has proven to work consistent enough to where I can continue to grind the portfolio higher. Doesn't, like I said, doesn't mean that every trade's a winning trade, but the winning trades are consistently larger than the losing trades, and over time the portfolio generally trends higher. So my suggestion is that traders find something that they are comfortable with, that fits their emotional capabilities, and that they can implement, and then stick with it. Jumping back and forth to what works at the moment is just a guaranteed way to lose money. For all intents and purposes, you're just buying high and selling low. You're jumping on the guru at the moment who happens to be hot, and then, as I said, every system has a losing trade. And usually, when a guru is pretty hot, then by the time you've noticed that he's making winning trades, then it's too late, and he's about to have a losing trade, and so you're jumping onto that system right before it's about to have a losing trade. And so all you do is you just jump from one system to the next over and over and over, searching for something that you think, somebody that you think knows what they're talking about. And that's just not the way markets work. It's not the way trading strategies work. Nobody can tell you what the future is. There's no strategy ever developed that can tell you what the future is. You just have to pick a strategy that wins often enough, and that the winners are bigger than the losers, to where over time you consistently make money. Jumping back and forth from one strategy to another, I can guarantee you, is not going to make you money. Find something that you're comfortable with and works over time, and stick with it. That's how you make money.